Printed in Fort Worth, Texas, accepted everywhere. Most of the world's trade is conducted in US dollars. And the currency's exchange rate often drives the fate of emerging economies as they try to grab a larger share of global markets. 2018 provided a chilling reminder of just how problematic this dependence can be for developing markets, as rising US interest rates sucked hundreds of billions of dollars out of other countries.
This is a delicate moment for the global economy. If the downside risks do not materialize and the policy support put in place is effective, global growth should rebound. If, however, any of the major risks materialize, then expected recoveries in stressed economies, in high-debt economies, in export-dependent economies may be derailed.
But now the US Federal Reserve is pausing rate hikes and ending a drive to reduce the number of notes in circulation, encouraging international investors to move back into emerging economies. Investments in bonds in emerging economies are up by more than 5.5% since the start of this year. That compares to a 2.4% rise in developed market bonds. Stock markets in developing economies have also seen the inflow of more than $12 billion. During the same period, $80 billion have been pulled out of equity markets in advanced economies. More than half of this money left European markets like France, Germany, and the UK due to a slowdown in these economies.
The outlook for real GDP growth has been revised down substantially in 2019 and slightly in 2020 on account of the persistence of uncertainties related to geopolitical factors, the threat of protectionism, and vulnerabilities in the emerging markets.
The International Monetary Fund says developing economies should use this as an opportunity to enact economic reforms to reduce debt.
With global and public debt, private and public, at an all-time high, any slight change in the wind could provoke capital outflows and economic instability in emerging markets, as we see it in some of those markets.
Some, like China and India, are using low US interest rates to take on more loans as their governments spend to prop up demand. Others are trying to pay down foreign debt to limit the impact of the next big move in foreign currencies. Mobin Nasir, TRT World.
For more on this story, the Daily Sabah's financial columnist Taha Arvas joins us now. Welcome back, Taha. So the World Bank and the IMF have painted a bit of a bleak picture on the world economy, citing things like Brexit and the ongoing trade wars. How much of that is going to impact emerging markets?
It will have a major impact, only because emerging markets are much more fragile than developed markets, and any type of uncertainty affects them more and impacts them more than developed markets would be affected. So they need more certainty, and in that respect, they're looking forward to conclusions of these issues, whatever they may be.
So how closely are the fortunes of emerging markets tied to those of the more developed ones?
Very much tied. And I'll give you an example. Recently, over the weekend, President Trump came out and blasted his own Federal Reserve for keeping rates too high, interest rates too high. And he said the U.S. economy would have been doing much better. In fact, he said, I think the markets would be 10,000 points higher had they not done that. So, and the Fed responded on Monday by the Chicago Fed president said that they don't foresee any rate hikes for the next 18 months. This is actually good news for emerging markets in that it allows them to know that there won't be competition as far as interest rates with the United States Federal Reserve, and so that it might give them more chances to get investments into their countries.
Okay, and what about this issue of another potential US recession? I know many analysts have been predicting one in the near future. I mean, is that a likely possibility?
The Fed appears to think that it is, and normally the Fed very rarely makes projections this far out in advance. So they've told the markets now for the next 18 months there won't be any rate hikes, and there may even be rate cuts, and this means they're expecting something. Obviously, they can't come out and say that they're fearful and things are going to go bad, or else there will be a run on markets. But I mean, if we look at fund flows, and I think we've discussed this earlier, Informa came out with these fund flows that show in the last week, countries such as Norway, South Korea, Spain, France have all had major equity fund outflows from their funds. And this means that people are divesting from, are getting their money out of these countries only because they fear what's going to come. They don't want to be in equities into risky assets. These funds are mostly moving to money market funds and bond funds, less risky assets, because of potentially because of these warnings we see from the Fed.
And as we all know, when the world's biggest economy, the United States, catches a cold, I guess, or sneezes, I should say,
Right.
the rest of the world catches a cold.
Exactly.
So what impact might a recession in the US have on emerging markets in this climate?
So if the 2008 Great Recession was any news or will be a good comparer or a good comparison to what's going to happen now, then there are emerging markets that can take advantage of the situation. If there's a slowdown in growth in Europe, which there is, and the United States, which there appears to be, then investments could flow to emerging markets. But many countries across the emerging markets have suffered in the last 3-4 weeks. They've done well overall since the beginning of the year, but these last 3-4 weeks have seen record outflows from countries such as South Africa and Brazil. They're beginning to feel the pinch of these talks of recession. So if they take advantage of these issues, and if they can attract investment, they'll do great. But if not, then the entire world will, as like you said, catch a cold here.
And what about these recent figures from France and Germany, Europe's two biggest economies, that manufacturing is contracting yet again? Emerging economies like Turkey export a lot to the EU. What impact might a recession there or a slowdown in Europe have on emerging markets?
I mean, it's a very important issue because not only does Europe face growth challenges, it also faces demographic challenges. We know what's going to happen in Japan and Germany and France and most of Europe in the next 10, 20 years. The population will get older. This means slower growth. This means they have a major need for immigration, for extra boost in their populations, which they're not going to have. So countries like Turkey, like Brazil, like South Africa, other emerging markets, India, are in need of growth, and Europe might not be the best bet. It might not be, they can't take it for granted as they once could have as an export market.
Interesting times. Taha Arvas, thank you as always.
Thank you.